It turned out to be a disappointing day on Wall Street. The bulls surged out of the session, in many cases up over 3%, with many of the beaten up travel and leisure stocks kind of leading the way, only to have some midday selling take us all the way back down to the zero line. So most of the indices closed down by just a fraction. There was some positive development over in China as the Wuhan district was kind of unquarantined and people were allowed to go and move more freely about. But here in the United States and in Spain and in Italy, some of the harder parts across the rest of the globe, we saw kind of mixed messages in terms of whether we're heading in the right direction here or not. So investors continue to grapple with this information. We'll take a look at all of that and see what that means for our posture. We'll then get into a trade application example today from the only bearish sector right now, with a stock that finds itself right in the epicenter of the coronavirus crisis at this particular moment in time. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 7th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. While you're there, check out our description area where you can sign up for our email distribution list, so that way you can be alerted whenever these videos get posted, and then also gives you a heads up on what stocks within the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. Those of you that follow David and I religiously will know that we've kind of picked up our pace on Twitter here more recently. With all the activity in the markets, it's hard not to kind of put our 2 cents out there for what it's worth. If you're interested in following our thoughts and also see what kinds of other stories and news affects and shapes our mind, feel free to follow me. My handle is @BrandonVanZee. And then lastly, we have a presence on Facebook as well. We'd love to see you over there. Check out our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, for once, I don't have to pull up the percentage move graph. And it's been a long time since I can say that. In other words, today was not a day where we moved more than 1% in either direction. And that is quite the rarity, at least for the last, let's call it, month and a half or so, as most sessions have been dramatically up or dramatically down. Today we certainly had some interesting movements, but when it was all said and done, it was a bit of a boring day. You can see the S&P 500 was down 0.16%, the Dow Jones was down 0.12%, the Nasdaq Composite was down 0.33%, and the Russell 2000 was the only one of these four that finished up, but just barely, 0.03%. So a really quiet day at the end result. However, there was quite the activity to start the session. You can see that these candles that we're dealing with here are all filled in red. The Russell 2000 looks a little bit different there because it didn't have the gap up to start the session. Nonetheless, the other three charts kind of have these thicker red candles that we're dealing with, which basically means we started the day with a gap up, and then we spent the entire rest of the day selling that off. Those of you that were following David on Twitter today might have seen that he had a nice called shot in the Market Outlook video last night, where he was kind of looking at those levels around, let's call it 2750 on the S&P 500 as a place where you might think about taking some profits, or there might be sellers there. That would equate to about 275 on SPY if you're looking at it from that perspective. But that is in effect approximately where we did meet sellers in today's session. And as you can see, not only is it a prominent red candle that we're looking at there, but its placement on the chart I would also identify as quite important. And the reason for that is this was our first test of the 30-day moving average, going all the way back here to February 21st. Boy, What a journey we've had since that day. Anyway, this is the first chance that the bulls have had to do a reversion to the mean move strong enough to push us up to actually touch the 30-day moving average. Well, you can see it was not met with kindness, as the 30-day moving average basically threw the market right back down below it. Now, regardless of where we are from a positioning perspective, above or below the moving average, and we know that we're below it right now because the moving average, you can see, is still colored red, unlike back here when it was colored green and yellow. You can see that the background color of the chart is light green, and remember, that shows up when we have a weekly bullish posture on the market forecast intermediate term line. So remember, if you're newer to these videos, the market forecast is a technical indicator, just like there are hundreds of other technical indicators out there. You can find it on the Thinkorswim platform over at TD Ameritrade. Anyway, it represents kind of an upper bound and a lower bound. That upper bound is at 80, that lower bound is at 20, and you have what's known as a lower reversal zone below 20 and an upper reversal zone above 80. When you have the green line traveling between 20 and 80, you have to ask yourself, first of all, what direction is it going? And that's where our labels can help. You can see here the intermediate green line is at 32 and rising right now. So we know the direction is going is up, if you see the rising portion of that. And then the next portion that we ask ourselves is, well, where is it along the way between 20 and 80? Since it's below 50 at this point, in other words, the indicator's midpoint here, it's only at 32 and rising, we do consider this only weekly bullish, not strongly bullish. If this green line were to get up and through 50, then at that point we would start seeing a darker shade of green on the background color, kind of like we saw back here, and we would consider that to be strongly bullish. So in other words, yes, there are some hints of bullishness out there, some green shoots as it were, but just be careful, right? And it's not advice. We can't give you direct advice. We're not your licensed advisors or anything like that. But just generally speaking, when we see the 30-day moving average trending lower, as we do right now, our first thought should be that the path of least resistance continues to be to the downside, regardless of what the posture is telling you at that exact moment in time. And then you start using some of your other tools, such as candlestick analysis, to help determine, what side of the fence do you want to fall on for your next trade. And so it's a little bit of a tug of war right now, with the path of least resistance continuing to be to the downside, but we do have a weekly bullish posture. If it were a strongly bullish posture, that would be an even more difficult debate. But since it's a weekly bullish posture, my sense right now continues to be that this is a market where you want to go forward with a bit more hesitation than normal. We've just had a very dramatic event take place in the last month. And while it's true, there have been long-term values open themselves up, there is also some psychological damage that's been done to market participants along the way. And as we've had a rebound off the ultimate low so far, which has been March 23rd, there are people that are thinking about maybe selling some of their positions while they can, as opposed to having to flush out of their accounts at worst possible time. So we've had a nice rally, more than 20% off the bottom. There may be people that are starting to think again about liquidating some of their positions now that they can get some better prices for them. So my expectation right now is still that we are going to eventually have to retest the lows. Whether we break them or not will depend upon the circumstances at that time. But I'm not in the camp at this point that suggests that we are going to go straight up and have this V-shaped recovery. And there are some people that have that viewpoint. There was a gentleman on CNBC today, I think his name is Tom Lee, that suggests that could very well be what we are in the midst of right now. So is it possible? Certainly. As always, you're going to have some people on one side of that argument and some people on the other side of the argument. But I think this was a big enough psychological event where it's going to take time for healing to take place In addition to that, we still don't have answers when it comes to the coronavirus, and I think that this is going to truly disrupt our economy in a major, major way. There are some businesses that literally will have no sales in the last several weeks. Without a doubt, that's going to do damage to its stock price. Now, a follow-up question to that might be, well, is it already baked in? And in many cases, that certainly could be the case. But we've got to be careful there as well. From my perspective, we are almost assuredly going to have a decline in profits in 2020 compared to where we were in 2019. And therefore, you might actually see PE ratios rise in the coming year. And it's not the good way, as I've been kind of explaining to my students in classes over the last couple of weeks. A lot of times when a PE ratio goes higher, you're enthusiastic about that because it's telling you more times than not that price is going up. I think PE ratio is going to be going up in the next year for the bad reason, and that means earnings, the other side of that equation, is going to be going down. So there's a lot of damage that's been done. There's a lot of work that we have in front of us, not only as an economy, but also here in the markets themselves. And so generally speaking, if you are going bullish at this level after a 20+% rebound off the low, you probably want to be a little bit more conservative with your position sizing and make sure that you truly feel that the merchandise you're buying is higher quality. Generally speaking, I think of these times as more of an opportunity to sell the rips than to buy the dips if you are a shorter term trader. So it's kind of my mindset right now, and we'll see if that plays out or not. But right now we've got a lot of work to do in front of us, and it all starts with getting past this coronavirus, which at this point we're not anywhere near that. So we got to start with step one first, and then let's talk about repair in the stock market after that. One thing I did want to point out is that the Russell 2000 is our lagging index right now. Yes, it is true that we have the only of the four indexes that were up today, but it was only up 0.03%. But remember, prior to that, it did not have as robust of a move off the bottom as some of the other indices that were out there. So this one has actually been bearish for the last week, whereas these other three charts have gotten that weekly bullish posture. In addition to that, you'll notice that the other three charts are all touching their 30-day moving average today, whereas the Russell 2000 has not gotten enough of a big push off of its lows to even touch its 30-day moving average yet. In fact, that brings up a reminder to me. I just posted this on Twitter here a moment ago. This is one of the graphics we use for my factor-based swing trading class, which if you're a plus or a premium member, you're invited to join me tomorrow, 10 a.m. Eastern time, to check that out. But anyway, the point of the post on Twitter was to identify that quality for the very first time in almost 3 months is number one again. But for our purposes here and having this conversation in the Market Outlook video, you will see that size is back on the bottom rung here, dead last. So size even underperformed value in the last week, and value is chocked full of oil and financial companies. And there's a little bit of a rebound in those types of areas over the last week, whereas we haven't really seen much of a pop out of the small cap universe yet. So size happens to be one of those factors that just doesn't seem to be working here right now. Let's go ahead and take a look at our next chart setup. In this case, we're going to take a look at our 3 green arrows chart setup. And here you can see we have one new thing to report, and that is in the lower left-hand corner. This is your Nasdaq composite. Remember, these are more growth-oriented companies, oftentimes leveraged to technology. You do see that the Nasdaq composite all of a sudden has 3 green arrows. How about that? It's been a really long time since we've been able to say that on any index. This is actually the very first one here today since late February, before we had any idea that this coronavirus was going to plunge the market into bearish territory in less than a month. You can see that the last time we had 3 green arrows would have been back here around February 21st, and that was the case on the S&P 500, the Dow Jones, Russell 2000, and the Nasdaq Composite. So anyway, some positive news there. Again, green shoots. We're happy to see that. Most of us have long-term positions, whether it's mutual funds in our 401ks or individual, higher quality dividend growth investing plays or what have you. So generally speaking, we like to see these green shoots. It's just that we have to be realistic with what we're looking at as well. Right now, we've got one, so that's a more positive sign there, where we now have price that is closed slightly above the moving average. We have the MACD histogram above the 0 line, and we have the stochastics trending higher, in fact, almost in the upper reversal zone right there. We'll wait and see on the other ones. But my guess is that there's going to be a little bit of back and forth in coming days as the markets try to determine whether they can break through those falling 30-day moving averages or not. And right now, my gut tells me that they're probably not going to be able to do it, but I hope they prove me wrong. Let's go ahead and take a look at some 12-grid analysis now, starting with chart 5A, and this will be our asset class 12 grid. Now remember, when we're looking at these 12 grid views, the background colors of the charts will tell us whether we have a bullish posture using the intermediate line on the market forecast or a bearish posture using that same line. There are different shades, so you can either have a light green or a dark green, or a light pink and a dark pink. Right now we have 3 out of those 4 possibilities shown in front of us. 2 of our charts right here are dark pink. That's high yield bonds, and that's oil. And for those of you that have followed my presentations here over the years, you should know that that kind of makes sense. Those 2 areas are highly correlated to one another, at least at this moment in time, because high yield bonds, another term for them is junk bonds, and junk bonds right now have heavy exposure to small and mid-sized oil and gas players. It's really the most disrupted industry, not just from coronavirus and everything that happened with Russia and Saudi Arabia, but this goes back months, if not years prior to that. So there's been a lot of small oil companies having to raise capital in the debt markets, and of course they're not going to get favorable terms there, so they throw them into the junk bond category. So right now you'll see both of those charts are that dark shade of pink, telling us that we have strongly bearish postures on them. And it was another disappointing day for oil, down about 7 or 8% there, as traders are grappling with whether, Saudi Arabia and Russia, who are supposed to get together later this week, if it even matters in the end. In other words, with the lack of demand across the globe, because many people are shut in their homes right now and not able to drive their vehicles all over town like they once were, there's just a major decline in gasoline usage. Now, of course, oil goes into a lot of other things, but I mean, for the most part, gasoline and other distillates are getting used less as we have a frozen economy. So, when we talked about that big move last week, I said we've got to be careful there, because we've seen those big moves before that send the posture to bullish territory. Just briefly, I pointed out that this was very similar to what happened with the drone bombing of the Saudi Arabia refinery last fall. And we got to be careful there, because what looks really exciting, a big move up for oil and a lot of those oil stocks going up, usually ends in heartbreak, or at least it has in recent years. And all of a sudden, here we go, rolling over again, back to a bearish posture on oil. Now, the other charts on the board you can see are lighter green or darker green. The lighter green means that we have a weakly bullish intermediate posture. The darker green means that we have a strongly bullish intermediate posture. So our stronger trends right now are the ones kind of in the left-hand corner here, starting with long-term U.S. Treasuries. This is TLT we're using for this. You can see that's a very strong trend there. So if you have a diversified portfolio across many asset classes, you might very well have some long-term U.S. government Treasuries in your portfolio. That's been one of those areas that's benefited from the chaos in the last month. The U.S. dollar also is reasonably strong. However, kind of had a nasty give back day today. Now, I'm not going to count it out because, again, the path of least resistance continues to be to the upside. We're still trading above a rising moving average there, but that was a little bit of a disappointing day. You had a really nice bounce for the US dollar off that moving average about a week and a half ago, and now all of a sudden it looks like it's kind of failing right there. So we'll see if it can, catch its breath right around that moving average and launch higher yet again. As I mentioned in one of the videos last week, I for one hope that does not happen. I don't want to sound like I'm not a patriot for the United States or anything like that. I'm a happy camper here, just like anybody else. But generally speaking, as a stock investor, I'd prefer to see a weaker dollar, not a stronger dollar. So that might actually help support stock prices if we were to see UUP drop below its moving average. But right now, I'm going to make the assumption that that's not going to happen. And right now, the assumption is the path of least resistance continues to be at the upside. We might very well see the US dollar continue to act as an area of safety as money tries to seek out that safety, especially if we get a sell-off in the market. That's when money starts selling out of stocks and it needs to go somewhere, and sometimes it just stays in cash in the US dollar. Here with gold, you can see that we've had some firming up here. This has been interesting. I've been trying to bring it up as I've seen it here in these market outlook videos. This was very disappointing and counterintuitive to me. In fact, I was pointing that out during the presentation, that it just wasn't making sense to me. Now, that happens a lot, so it's not as though that is unheard of. Stocks and assets are going to do whatever they need to do, and sometimes you just don't have it figured out. But to me, it didn't seem normal that gold was falling apart right there, and I kind of got the sense that it was being used as a source of funds. In other words, there were lots of margin calls going out in mid-March. Lots of people were just getting trampled on with their stock portfolios. And so one possibility might have been that when your broker calls you up and says, hey, we need X amount of dollars and you need to get that to us by noon or whatever it is. I've never had a margin call, so I'm not sure about that exactly, how that works. But point is, you're looking around in your portfolio of something that has retained some bit of value, and gold might have been one of those areas. While it was down, maybe 5% or whatever it was during that time, that's better than a lot of those growth stocks or energy companies that are down, 20 to 50%. So, that is one possibility as why as gold kind of fell out of bed right there, is it was used as a source of funds as traders needed to free up capital to satisfy their margin calls. But you can see since then it's behaved a lot better, and we're actually up here now fairly close to multi-month highs. We need to go up a little bit more to get where we were trading at the beginning of March, but nonetheless, we are looking better on gold as an example than you're looking up here with SPY. So as you're looking at these different asset classes, to me it seems like gold is the stronger bet here than what you see out of the general stock market. Let's go ahead and take a look at another set of 12 grids. In this case, we'll take a look at the sectors in the United States. This is chart 5C. So as you can see, we've got one odd man out, and that is down here in this lower territory, and that's utilities. Utilities have been, surprisingly weak, I guess you would say, comparatively. You can see that utilities did not touch their 30-day moving average here recently, whereas you can see the staples and healthcare and discretionary materials, technology, communications, all of those touched their 30-day moving average. So we have a little bit of relative weakness coming from the utilities here, where it was not able to rebound enough to touch that downtrending moving average yet. We'll see, maybe that's still to be in the cards, but as of this moment in time, it hasn't been able to do that. You can see the last time utilities did break down below the moving average, came back up and touched it, it failed at that level. So let's say tomorrow utilities do come up and touch that downtrending 30-day moving average. It is possible that that is another reason why it ultimately rolls over. And you can see there's a pretty strong level of resistance right here on the chart as well, horizontal resistance, where we have a touch point from back here on March 30th and another touch point back here on March 17th. So you've got a little bit more technical damage done there with the utilities, which actually brings me into my trade application example for today. So let's have that conversation. Before we get into the shorter term charts on my candidate here tonight, I want to bring up a longer term chart first, just to kind of give you a lay of the land from a longer term perspective. Many of you know that folks that traditionally buy utilities oftentimes are interested in its dividend paying potential. And so one stock I wanted to bring up today that's in the epicenter of this whole crisis right now is Con Ed, ticker symbol ED, Edward David. Con Ed, of course, is one of the longest held publicly traded utility companies out there. In fact, it's one of the only utilities on the dividend aristocrat list, meaning it has raised its dividends for more than 25 years in a row or more. Many of you that have ever lived in New York are certainly familiar with it. In fact, many people who have never lived in New York but are just fans of pop culture probably have heard of Con Ed. I remember Con Ed being on the Ghostbusters movies as just one example. Anyway, not really on point, but what I will say that is on point is that at this particular juncture, I would view Con Ed as being closer to overvalued than undervalued. Remember, I can't really make that claim with so many other companies out there. In fact, for the true blue dividend aristocrat list, my guess is if I were to pull it up here on this chart that we supply to our premium members of Market Scholars, remember each one of these dividend stairstep charts are different to each company because it's basing it on its prior dividend yield history. My guess would be if I looked at all the aristocrats that the vast majority of them would be viewed as undervalued right now after the big market washout of the past month. This is an example of where you did have, for a very brief moment in time, right here with one stick right there, so that's a bar in this case, not a candle, but these are weekly bars in this case, for 1 week. At the worst part of the selling, you did dip below this blue line where we might have been able to say, okay, now it's undervalued. Let's buy it down here at $68 or less. But you can see it's had a monstrous move higher, and it almost came right back up and touched the orange line where we would perceive it to be overvalued. So right now it has fallen back. Like a lot of other utilities, it did fall today. It was down 1.39%. So we're back down here at just under $80 per share. But nonetheless, we are closer to the orange line than we are the blue line. In other words, we're closer to what I would consider to be overvalued than undervalued on Con Ed at this exact moment in time. So that's kind of like the longer term view of this company looking back over the last 10 years. Let's now kind of zoom in using chart 3A, and this is the chart that I tend to use for our swing trading classes that I'll be teaching tomorrow morning. By the way, speaking of dividends, here a moment ago, I did teach my dividend growth investing trading room earlier today where we focused on the industrial sector on a couple of dividend aristocrats there that we perceive to be somewhat undervalued. I have not received the recording file back yet from WebEx, so if you're a premium member and you've been looking for that all day, my apologies there. I have been checking on it all day, but I'm guessing that Cisco has been extremely busy in the last month with so many more people working from home. So there's a bit of a delay there. As soon as it does become available, I'll get that posted to our calendar so that way those of you that were at work during the live session today can check out the recording there. Anyway, back on track here with this chart that we use for my swing trading class. Pulling up ticker symbol Con Ed ED, you can see here that this is a compelling situation to the short side of the market, and that's what I want to focus on here. Again, longer term, looking at the dividend analysis, we might have some reason to believe we're closer to overvalued. Shorter term, from a technical analysis perspective, there may be some reasons to believe that as well. So as one example here, you can see that the background color of the chart changed from blue to pink yesterday. That is signifying that using this blue near-term line on the market forecast, we now have a bearish near-term posture. In addition to that, you can see that this stock has touched its 30-day moving average for the last 2 days. Now you can see that this company did that back here as well, and it failed. In fact, it did it back here on the 10th of March for one candle, failed at that level. It gave it more of a college try right here from March 17th through March 19th, but still ended up failing with a really nasty drop after that. So right now, the path of least resistance continues to be to the downside, and this is looking like a bearish engulfing candle that we had right here, and maybe even a little bit of bearish divergence setting up on that near-term line as well, as we've largely been trending higher since bottoming on stock price action. Yet you can see we've been setting some lower highs on the near-term line itself right there. Now, one thing to be aware of, this company does have earnings coming up, potentially. Some companies are delaying their earnings announcement, but we are heading into that part of the year here, or part of the quarter, I should say. So be aware of that. There are different ways you could think about trading this. What I'm going to do in this case is just short sell the stock outright. Now, remember, that can come with some danger. If the stock for some reason makes, an obnoxious amount of profits on its quarterly return, maybe the stock gaps up, and it could have the potential of gapping up and through your stop loss. But my hunch right now is that Con Ed is probably not going to be reporting a massive amount of profits. For one thing, it would probably look bad, right? Right now, New York City is the epicenter of this coronavirus crisis here in the United States. And if Con Ed is out there making, jaw-dropping profits, it probably isn't going to sit all that well. So if they ever have kind of an excuse to lowball the number, it might very well be in this environment where we find ourselves right now. In addition to that, there may be a lot of people that just simply decide they're not going to pay their bills to Con Ed. I'm not suggesting that anybody should do that, but I'm just talking from a realistic perspective. There's a lot of people out there that are just deciding, I'm not going to pay my rent this month, I'm not going to pay my utility company, et cetera, et cetera. Now, it is possible that, maybe the government steps in and pays it on their behalf or something along those lines, but you do have to kind of think about how this coronavirus is affecting different companies' business models along the way, and I don't think it's really doing many favors to Con Ed. Remember, there are a lot of places in New York that are just completely shut down, skyscrapers that were once brimming with the activity of the office worker is just closed up, and the lights aren't on. If the lights aren't on, then Con Ed isn't making as much money as they would have there. And if those people that worked in those office buildings had commuted from New Jersey or Pennsylvania or something along those lines, you're not even going to get it back on the residential side. You're just simply missing out on it entirely because the commercial side is not turning the lights on, and you're not getting the residential side as the residents live in a different state. It's true that Con Ed does do some service territory in other states, but for the most part, this is kind of a New York City-based company here. So let's go ahead and do a short sale on this. What I'm going to do is I'm going to provide a very wide net here. In other words, I'm not just going to get nicked in and out on some sort of a juke move. I want to give this a little bit of room to work. So what I'm going to use as my bogey in terms of upside risk that I'm willing to take is this candle over here. You can see the highest price it printed in the last 3 months is $95.10. So I'm going to put my stop loss just 2 pennies above that. In other words, if I'm going to lose on this trade, this stock has to prove it to me. It has to earn it, and it's going to have to go out and hit multi-month highs. In fact, that might even be an all-time high. So if that happens, fine, so be it. I'm willing to admit defeat. If that doesn't happen, then right now, my assumption is that the path of least resistance could very well continue to push this company lower here in the coming weeks and months. And so if I wanted to maintain a one-for-one reward-risk relationship, then I need to determine how much risk per share am I taking on the upside, so that way I can set my price target on the downside. So let's get our calculator out here. I'm going to take $95.12, which again is 2 pennies above the prior intraday high. And I'm going to subtract out where we closed today, where I'm going to try to get filled tomorrow morning, which is $79.92. So just barely below $80 per share. So if I just subtract those two numbers, the amount that I get is $15.20. So that's how much risk I'm taking on a per share basis to the upside. Some of you might decide to play it a different way, and that's of course completely fine. But as I mentioned before, I'm giving myself quite the wide net to cast here, where I don't want to get just nicked out by a penny or two. I need it to work and continue to drive higher before I'm forced out of this trade. And so if I were to then subtract $15.20 per share from the current price, so subtract 79.92, that brings us down to $64.72. So that will be our price target down below if we wanted to maintain that 1-for-1 reward risk relationship. 64.72 will be right down here to almost the bottom of this candle. So this candle's low that I'm pointing at right here on the 24th of March was 64.58. So if it was able to get to the low point of that candle, we would have already been out of our trade, locking in our profits, let alone if it were to go to this really low candle that it had the day before that. So let's give that a shot, see if we can get a little bit more bearish on this particular stock that finds itself right in the center of the coronavirus and also coming from a sector that's currently our only bearish sector from a posture perspective, the utilities. So in order to do a trade like this, I'm just going to right click on the chart. I'm going to come over here to sell custom with OCO bracket. So again, not buy custom, sell custom with OCO bracket. That loads up our trade down below. I'm going to click this little paperclip icon right here to kind of lock all of those different pieces of my order together. I am just going to leave this at 100, right? I'm not going to do a whole lot of position sizing here, but obviously you're going to want to position size for whatever's right for your personal account. But you know, in our purposes here, it's just for education. So we'll leave it at the default of 100 shares. And I am going to try to get filled tomorrow morning at the price where it closed today. So that was $79.92 limit. And I'm actually going to change this to good till cancel, just in case I don't get it filled tomorrow. I'll be willing to think about it again in another day along the way. So $79.92 is we're going to try to sell this short using a limit good till cancel order. The next line directly below that will represent where do we want this stock to go? In other words, what's our price target? And that's what I mentioned just a moment ago. $64.72 is where I'd like to see this stock go after we get filled. And we will put that in as a limit order. And again, change this from day to good till cancel. Directly below that, there's another day, and that's for our stop loss. I need to click that and also change that to good till cancel. Then finally on that bottom line, that fourth line there, that's where we're going to put our stop loss. Now remember, in the case of us short selling a stock like we are here, the stop loss is actually a number above us, a higher number. And that's what I mentioned before, $95.12 is where we're going to put our stop loss in this particular case. Now that we've got all of that filled, I'm going to click confirm and send, review this again. Everything looks good to me there. So we'll see if we can get filled first thing in the morning. Thank you for joining me here yet again. As I mentioned previously, it was a bit of a disappointing day for bulls, as it looked like it was going to be a robust market rally to start the session, but ultimately faded at the end of the day, only closing flat and giving us some more bearish candles along the way. So thought we would try to take advantage of some of that bearishness there in the utility sector with our trade application example here tonight. I hope you got value out of tonight's video. If you did, the way that you can show your appreciation is by going over to Twitter, where I'll have the tweet for the market outlook posted or pinned to the top of my timeline to make it nice and easy for you to find. All you have to do is click a like there. You can also do that directly within the description area of YouTube, and also do that while you're watching the video on our website at marketscholars.com. I'll look forward to seeing many of you in my swing trading class tomorrow morning, and then David, of course, will be teaching his options inventory class tomorrow afternoon. We look forward to seeing those of you that are premium members in those classes. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.